Welcome to the G360 Wealth Podcast. Today, we are welcomed by an exceptionally special guest, Mr. Christopher Zook. Christopher is the founder and chairman of CAZ Investments. He is the chair of the Texas Pension Review Board. He is a New York Times bestseller, co-host of the Holy Grail podcast with Tony Robbins, and among many other things that I feel like Phil Mickelson when they announced Tiger Woods' accomplishments on the tee box. Christopher, thank you so much for being on the podcast.
It's my pleasure. Thank you for having me.
I want to kick off the podcast and this conversation with you before we talk about investments. And I know we could go on for hours about asymmetric returns, the CAZ scale, valuations, public equities. But I want to take a step back. I was lucky enough to spend some time with you a couple months back. And one of the things that stood out to me the most, Christopher, was your process and attention to detail, not only about investing and business, but how you take care of yourself. Your dedication to health and wellness has inspired me. I'm wearing a Whoop right now. I'm on Newcom, but I would love to hear, starting from the top down, from somebody that I think you are coming from Japan, traveling to somewhere else. How do you take care of your health? And then furthermore, how does that integrate into returns in leadership of CAZ?
No, I appreciate the question. It's definitely one that I don't answer that often. What I'll tell you is that discipline is what drives pretty much success in every field. And so I don't believe that someone can just be all in, fantastically disciplined in what they do in their business and just completely ignore their health because it will catch up with them, or other aspects of their life as well. But when it comes to health specifically, what I have found is that the more regimented I am in my structure, my morning routine, the way that I take care of myself, the way that I eat, the way that I exercise, it just helps me be better at everything that I do. It sets me in the right state of mind to start the day. And it gives me the energy and the focus that I need to be able to be the best version of myself that I can be. And obviously, I'm like everybody else, and I don't do it perfectly every day. But every day I strive to stick with my agenda and my schedule. And I have very specific goals that I want to accomplish. And I've always been a very goal-oriented person. And so as a result, health is no different than that. I try to stay focused on it every day.
It's inspiring to see it in real life. Now, I did see you eat dessert, so you are human, but it is inspiring to see your level of commitment. When you talk about goals, before we start talking about sports franchises and GP staking and energy, what are your goals right now? CAZ has been going through a real evolution right now where it's starting to become a household name. I had somebody email me yesterday, they saw me on Schwab TV and said, "Hey, can you provide me access to GP stakes?" So that was a moment right there where I know there's some democratization going on. But what is CAZ working on right now? And maybe share what some of the successes have been.
Well, we've been very fortunate. We've done a good job for people. We're 25 years old as a firm. And what we really have always done first and foremost is investing our own capital in whatever it is that we think is going to be the best opportunity for us. And then we'll bring the entire ecosystem with investment advisors like yourself and the clients that work with those advisors into whatever it is that we're doing. And, when you start thinking about goals and tying it all together, there has to be a reason for what we do. There's a reason why you have your business. There's a reason why each of your clients do what they do. And hopefully it's a very meaningful reason to them. For us, after about 20 years, we just had to take a little bit of a fresh look. And one of the books that everybody in our firm, when they join, must read is a famous book, Good to Great, and then Build to Last. And one of the concepts in those books is a big, hairy, audacious goal. BHAG is what it's called. And so we looked and said, okay, we've always had BHAGs as a firm, how much we want to grow, how much we want to deliver in returns, those kinds of things. But what is it really all about? And the answer is it's about how much money we make for those that entrust their capital to us. And so another concept that I should lay out is with a BHAG, it needs to bring the entire organization together. And so we had a real desire to have a central theme for the firm and everybody who works here to be able to truly know that every day we're working towards the prize and we want to, keep our eyes set on that prize. And so for us, we're 4 years in now. Our goal was to make $20 billion in realized gains, $20 billion in gains for the investors who invest with us in 20 years. And at the time, keep in mind, we were at $2.5 billion in assets. So $2.5 billion to generate $20 billion in profits, that's obviously a lot. But we said we knew we could achieve it if we make great investments. And if our capital formation team helps spread the word about what we're doing and we get a lot of money into those investments, and our investor relations team makes raving fans of all of our advisors and their clients, and that our operations team does a great job in reporting and delivering to promise, as we call it. And if we all do that together, then we have the ability to achieve that goal. So 20 billion in 20 years, we're 4 years in. We've already generated well over $1 billion of gains for investors over that 4-year period of time. So we're on our way, but it's going to be a lot of work to get there. But then from there, we do have some fantastic things coming out of the laboratory that we're really excited about that are going to be coming, being available to folks, hopefully in the next couple of months.
Well, I was very lucky enough to see a sneak peek of you in the laboratory. I'll keep that moment private between you and I. But it's one of the things that I love about you, Christopher, is innovation. When I was in grad school, one of my professors told me the key to business is innovate, right? Innovate or die. I feel like in wealth management specifically, when I looked around when I was, a young lad at Merrill Lynch, I was like, these people hate innovation. And this marketplace needs to be innovated. And it's pretty spectacular of what you're doing to democratize these types of investments. For our listeners out there, if most of them have read The Holy Grail, if you haven't read it, I strongly encourage you to email our office. We will send you a copy. One of the things you highlight in the book, and this is one thing we highlight to clients when they allocate to investments, is if you call Vista Equity Partners and say, hey, I'm Sam, I want to invest $50,000 in your latest flagship fund, they'll probably laugh at you politely and say, no, you're not. You need to add a couple zeros onto that. Can you talk about, is it important to you, and is it part of the thesis that everyday Americans who have worked hard and saved their wealth to allow them to have access to these special investments, and what makes them special? Well,
the short answer is absolutely. It's something that we're very, very passionate about, because we don't believe that somebody, just because of the fact that they don't have enormous wealth or income, should not be able to invest in things that are really potential good opportunities. And so we're very, Tony Robbins and I worked very hard behind the scenes and with Congress to try to actually get legislation passed to be able to enable people to take a test to become an accredited investor. Lo and behold, just about 8 weeks ago, the SEC came out and said, nope, don't even need any legislation. We're going to change the rules to where now anyone can invest in certain funds, to be clear, certain funds, no matter their wealth, no matter their income, no matter their education. As long as they can meet the minimum, they can invest. So it's a completely new world that we're dealing with right now, which has pros and cons, right? There's going to be a lot of people that just flood into something they don't understand, and that's something that can be dangerous. So it's important for someone to work with an advisor to be able to help curate what is the right solution for their particular family. And that is really critical. But what we want is for every advisor like you and all of the rest of the advisors out there to be able to do what's in the best interest of the client, regardless of whether or not that client is, $100 million client or $1 million client or the grandson of a patriarch or matriarch who's just getting started. We want them to all be able to invest in what we believe to be the best opportunities and where we're investing our own personal capital. So we strive every day to be able to do that. And I literally have been in the laboratory for 3.5 years working on something that if, capital I, capital F, if everything works according to plan here in the next 60 to 90 days, because of the rule changes, we're going to be able to roll it out to the world. And it'll be something that we're going to be hopefully very, very, very early on, and the ability to really add a lot of value to everybody that's watching this and everybody that obviously learns about what we're doing. But one of the things you said, I want to just double click on. Innovation is what it's all about. Complacency, it's an old saying, but if you're not growing, you're dying, right? We all know that. So a big part of taking care of our health, a big part of taking care of our investment portfolio is innovating and looking at what the opportunity set is in the future and making sure that we adapt properly to whatever that's going to look like. That is what the laboratory is all about. And we are relentless in trying to make sure that we're doing the best job that we can for everybody involved in the network. And sometimes it means we got to create stuff that's never been done before.
I mean, it's exactly right. That's what you've done, but I think one thing, and maybe I'll share why I think alternatives and GP stakes, among other funds that you have, is important. Our philosophy, and I'd love to get your opinion on this, and if it aligns, as Generation Capital, is core and explore. Oftentimes we tell clients simplification is the ultimate form of sophistication. On the public side, we're low cost beta. Right? That market is super efficient, but where we can add value is the alternatives. And especially in this environment, what we're telling clients is that fixed income isn't fixed or income right now. And you have to be able to keep up with purchasing power. If you cannot keep up with purchasing power, it's going to slowly kill you. And what we need to do is create asymmetric returns. So that way clients aren't in 100% Vanguard S&P 500 and throwing up on themselves when there's tariffs or there's events that they don't, that negatively impact the markets. But they also need income and they need capital appreciation. So we're telling clients, keep that core and explore philosophy and add alternatives. And I think that's why it's really important for clients trying to meet their financial goals. So if you go out and buy the 20-year bond ETF, well, that's down 40% over the last 5 years. Is that safe? I don't think so. Does that align with how CAZ thinks about integrating certain solutions into the portfolio?
Absolutely. And it's something to where, we don't need to talk about the genesis of the firm, but, my roots going all the way back to 1991 have always been investing in the public markets and adding alpha in those markets. And always did a fantastic job of that, did really, really, really well. But as the markets developed, by the time we got into the mid 2014, 15 range, it became very clear that everything was basically becoming indexed and that you really weren't going to add a lot of alpha in a consistent and persistent way in the public markets. So we actually spun off that business into a standalone company, gave those team members an entrepreneurial opportunity, and we focused everything of our efforts in the alternatives world because that's where we felt for our own personal capital that we would be able to generate the most alpha, the most opportunity for exceptional rates of return. And, for your audience who doesn't know it, I mean, we've got $650 million of our own money in our own vehicles. So we're the largest investor in everything we do. We're the first investor in everything that we do. And so we truly are aligned with you and with all of your clients because we are literally shoulder to shoulder in the investments that we're in. Well, and when you think from that lens, just being out there and just accepting the fact that we're going to, pay expensive fees to get beta, that doesn't make any sense. So being able to do, as you put it, the core and explore, I like the way that you put that because it just gives people the ability to have the proper allocation, diversification that is necessary across public and private markets, but to do so where there's the most opportunity to win and the most opportunity to be successful, and obviously the most way to add value. And so for us, we want to be part of that solution to where we're going to be able to find things that people will never be able to get into on their own. I mean, literally, you got to write one of the things we looked at just the other day, it was a $500 million check just to get invited into the investment, right? That is hard for most families to be able to do. Some can, not many. So that gives us the ability to aggregate, and the power of the network is the network to where when you think about all of your clients and all of the buying power they have, and all of the other advisors that we have all over the world that invest with us, that becomes enormous buying power, which is how we can write a $1 billion check into a single investment. And also how we can get in front of where potential trends are or where potential themes are going and the opportunity to invest in things that are really just differentiated And then, of course, we can try to create some structure around those to make them even more easy for investors to be able to use, for investment advisors to utilize for their clients with enhanced liquidity or predictable income or those other kinds of tools that we have in the tool chest to be able to make them fit in the portfolio. But so we're very passionate about that. You have to constantly innovate. And I love the core and explore concept because that's where the opportunity is today to be able to add value.
Yeah, I'll share two studies with you, Christopher, that I think align with your point. One of them, I believe Fidelity ran a study in maybe 2018 that of their best performing accounts, those were inactive, meaning they had lost their password or dead. So if that doesn't align with your efficiency in beta there, nothing does. And Morningstar, I believe, ran a study shortly after that, ranking on the public side managers on alignment. And there's such a high correlation between eating your own cooking and not. So kudos to you. And obviously, it's been very fruitful for all the investors. Let's talk about CAZ's thematic investment philosophy. Most of our clients, and we'll double click on GPO, are familiar with GP stakes. But can you talk about some of the themes? If you've read the Holy Grail, obviously you know sports. But talk to me about how did that start, and then how did the evolution of your focus to being able to deploy this to private wealth clients take shape? Because most folks that are in your seat are looking exclusively at pension funds or the ultra high net worth. But you can invest in CAZ, in various different funds as an everyday American.
Mm-hmm. The evolution is the first that'll answer as part of that question. So my entire career I have spent prior to starting the firm in 2001 in the high net worth world. So that's obviously where I was comfortable. I was in an advisory capacity. I was a wealth manager, just like you. And so I understood very much the needs and the challenges that wealth managers have and also the clients have. And so one of the things that really has always been a driving force for us is to be in a position to provide opportunities to solve for those challenges and to be able to enhance the opportunities that are available to wealth advisors and their clients. So we do have institutional investors as well, but at the same time, they have a very, very crowded list of things that they can consider doing. And so purely from a business perspective, being able to, and it's, goes back to the very simple statement of what is business: find a need, fill a need, get paid. It's that simple. So if we find a need that there's a lot of people that would like to invest in things that they would not be able to, and we can give them access to that and do a fantastic job, hopefully doing that for them, then everybody benefits, everybody wins, and everyone loves to get paid to add value to other people. So the thematic approach has been around since literally 1991 when I got into the industry, 1990 technically. I've always just thought that way. I've always been somebody who just loves to see it from the top down first, and then also invest from the bottom up. So top down, where is the world going? Where are themes that we could potentially participate in? And then what specifically the investments are that we would make. And it's interesting. I had a conversation with somebody last week in a similar format. And they asked, how do you determine the theme? How is it that you just decide that you're going to pivot and all of a sudden go all in on something like a GP stakes or professional sports or whatever? And I said, it's almost always the same thing. It's a no-brainer. It's when you look at it from every possible direction and you go, well, of course, this trend is going to happen. And the easiest example for me is when we shorted subprime mortgages with John Paulson in 2007. Anyone who is willing to admit it knew that the housing bubble was going to burst. Now, a lot of people had a reason to not want to admit it, but anybody who was willing to look at it objectively said, okay, of course this is going to burst. Well, at that point in time, we had to try to figure out a way to profit from that obvious conclusion. The tech bubble bursting in 1999, the bear market, ending in 2009, in March of 2009. You can go to our website and read all these letters that we've written back over 25 years now. When you read them in hindsight, you go, well, of course that was going to happen. Well, yeah, now in the rearview mirror, but at the time, the logic and the rationale is kind of bulletproof. And the one that I use as the best example is sports. Everybody hears that we invest in sports and they go, it's just because it's cool and it's interesting. Well, it is cool and it is interesting, but that's not why we're involved. We're involved because of this theme called cord cutting. And pretty much every single person on the planet will agree that people moving from broadcast and cable to streaming service is an irrefutable trend, and people aren't going to reverse and go back to broadcast and cable. Well, if that's true, then the only way for advertisers to reach their audience is through live events. So in 2005, 15 of the top 100 watched programs, live events, were sports. In 2013, it was 97 of the top 100 were sports. So 2023, 2023, 97 of the top 100 were sports. That is absolutely irrefutable. Well, then if you own the content, live sports, then you have a lot more pricing power. And then there is this other thing called a legal monopoly in North America. Nobody's allowed to compete with you. It makes for a really good business model. But that's just another example. And it could be artificial intelligence. It could be cloud-based computing. It could be healthcare for an aging demographic. And obviously the growth of private assets, which takes us to GP stakes. We developed a theme, find the best risk reward, and then we're going to find the right partners. And this to me is our edge. And somebody asked me another podcast about a month ago, why is it that CAZ is different? What makes it different? And I said, there's a lot of reasons, but at the core of it, it's that we never, ever have to make an investment. Never. It's my money first. It's our team's money second. We don't ever have to put our money into something. We get to choose if we want to do something. Because for most people in our industry, this is not a fault. This is just the reality. The old saying that if you're a hammer, everything looks like a nail. Well, if all you believe is in lower middle market healthcare and that's your specialty, well, then everything looks like a good deal. Well, in our world, we might think that's a great deal and we might think it's a lousy deal. We were one of the largest investors in real estate in 2010, 11, 12, 13, post the GFC. We have virtually no real estate now. Why? We don't have to do it. So in 2019, when prices were silly, we sold almost everything that we had. And then obviously now we can position ourselves, whether it be in sports or GP stakes or energy or healthcare, wherever the opportunity is, that's where we'll go.
You told me that you get 1,500 investments that come across your desk. You're right. You don't have to do anything. You always have the option. You can close funds. You can be nimble. What's the process? Knowing you, I'm sure there's a very regimented process, but how do you handle that? How do you make sure you don't miss the needle in the haystack? And then contrary, how do you avoid the downside? I know you're very keen on protecting the downside, and that'll take care of the upside, as you say.
So the 1,500 investments a year is probably going to be a lot closer to 2,000 this year, but it is a blessing and a curse because you want to see all the opportunities, but you've got to cull through them and triage them to figure out what it is you're going to focus on. One of the advantages of being thematic, and I assure you, we do miss out on opportunities that maybe aren't a needle in a haystack, but they're just good opportunities. They just don't fit what we're looking for from a thematic standpoint. But that's the first lens. Does this fit a theme of ours? If not, what makes it so compelling that it would cause us to drop everything else that we're doing to say, we've got to do this? Does that happen every once in a while? Maybe once a decade, but most of the time it's got to fit a theme of ours in order for us to dig in. But even before that, out of the 1,500 to 1,800, there's a whole lot of what I refer to as PowerPoints in the garage. People that have great ideas, but there's no way in the world they're going to get my money. All right. And it's why for so many high net worth investors, something going back to your point of our passion, for so many high net worth investors, they invest in alternatives because they hear about it in the locker room or they hear about it from a buddy or this, that, and the other. That doesn't mean it's a bad investment, but the odds are good. If you're hearing about it in the locker room, the odds are high that people like me and a lot of other professional investors have passed and it's not worthy of an institutional dollar. So that's why you have to be just really, really careful. Talk to Sam, talk to the rest of the other folks, on the team there and come up with the right approach of, okay, is this really a great investment or just investing because I happen to have access to it? So with that, it's very easy to eliminate probably round numbers, about 500 a year that are just not real. They're just not ready in some cases. The other 500, we're probably going to go, they're just not fit a theme. I mean, we look at so many multifamily deals right now, it's not even funny, apartment complexes. And it's an easy pass. Unless it's something really different, really unique, it's an easy pass for us. At some point, we'll be very involved. That's not today because of our worldview, and it's not one of our core themes. Then you get down to about 500 that we've got to actually do some work on. From there, the good news about owning stakes in over 100 different firms in private asset that manage private assets is that we can triangulate and use our network very successfully to be able to identify, is this firm real? Is this co-investment real? Is this secondary opportunity worth our time? And we can eliminate a lot of the noise very fast to get down to usually about 200 to 250 a year that we really got to dig in. And that's 20 a month. That's not small. But because of the fact that we're partnering with hopefully the very best in the world at what they do, and we're able to identify them, it makes it very easy for us to dig in and then ultimately make the investment if it makes sense, always through the lens of two lenses. Okay. Number one, is this someplace I'm going to put my personal capital, my family? And number two, what's the worst case scenario? If I can live with that, the upside will take care of itself. That's right.
And I will say I totally resonate as somebody who plays a lot of golf. Hearing things on the first tee. I am glad the CAZ laboratory is not in the locker room, right? And a mentor once said, to your point on passing on investments, sometimes the best investments are the ones you don't make. But I think kind of diving into that and looking more on the alternative space. Obviously, you probably won't admit it because I've got the humility too, but I look at you as one of the greatest alternative allocators could be ever. What should investors think when, we work with multiple generations? Everybody has different client needs. Our clients are being pitched by everybody, different alternative investments. I'm being pitched by everybody. I can't go through a day without hearing about a new non-traded REIT, a BDC, a new evergreen private equity fund that has no track record. It's probably 4 or 5 times a day. We love alternatives. We love working with CAZ because CAZ has a process and a long track record. What should investors think, or more savvy investors think, and what should their process be when a financial advisor sends them an alternative investment? What should they be looking at? If I sent you a private credit fund or a direct lending fund or a non-traded REIT, what would you be looking at, and how would you talk that out loud if you were sitting at the table with your family?
One of the things that's really helpful, and I think a little bit of an advantage in the private markets compared to a lot of things in the public markets, is that most of the time you can easily identify and understand why you're going to win or lose. In the public markets, you could have a company that does every bit above expectations compared to what they were supposed to, and you can still see the stock get crushed because of things that have nothing to do with the company. Okay. Now that can happen in the private markets for a time, but if you grow earnings, profits at a business from $40 million a year to $90 million a year in 3 years, you're probably going to make money, and you're probably going to make good money, and you might make exceptional money depending on how successful you were at the buy side of the transaction and on the sell side, obviously. But so for most people, when they talk to their children or their grandchildren or their spouses, whatever the case might be, about investing, they overcomplicate it. They try to explain it in a way that a professional would explain it. Don't do that. Even when I'm talking to investors, I feel like if I am talking to them in acronyms and jargon and things of that nature, I am doing them a disservice. So what I try to do is to help them understand in ways that they can understand. Now, speaking to somebody from their frame of reference is always a good idea. But if I was talking to, my son who's 30, I'm not going to talk to him in a way that I would talk to somebody who's 65 years old and sat on, was CEO of a public company and sat on boards and stuff like that. I'm going to talk differently to a 30-year-old who happens to have been around the industry for a lot, but he's not in the industry. Same thing when my grandson is old enough to be able to talk to him about investing. I'm going to make it real for him. And I think most people have heard this, but like when my son was young, I gave him gifts of stock. I gave him some Toys R Us back when Toys R Us was around. I gave him some Home Depot, and I gave him some Amazon, and I gave him some Under Armour. Why? He would understand the business model. Now, he didn't understand why stocks went up and stocks went down, but that gave us an opportunity to have a conversation of, okay, Dad, Under Armour went from $18 to $9. Why? Okay, well, let's look at it. Earnings went from here to here to here to here to here, and the stock went down to 9. What does that tell you? I have no idea. Well, guess what? The market's an emotional animal. Same thing in the private markets. Okay, so let's say this is private credit. Got to make a loan to a company. They got to be able to pay us back. That's the most important thing. They got to pay us the interest on that. Here's how we might evaluate them to say, okay, are they credit worthy or are they not? And you continue to go through it. It's one of the reasons why real estate is a very popular investment for teaching purposes. Most people get that somebody needs a place to live, and they're going to have to either buy the house or they're going to have to rent the house. So I use real estate a lot to be able to explain it to people. The good news is as they get more knowledge, then if you're going to talk to them about GP stakes as an example, then it's a really easy thing to talk about. Okay, somebody goes in a fund, they pay a fee and they pay a carry. And that's what we get to be the owner of that. And then obviously the easiest to explain to a next generation is something they're interested in. Sports is usually one of those things. Okay, not always, but most of the time. How do they make money? I assure you they don't know, because I didn't even know this until a couple of years ago, that when you own one NFL franchise, you actually own 1/32 of the NFL. And so to explain to a child or a grandchild and say, by the way, this team could finish last in the entire league, and they still get a $400 million distribution from the league this year. Wow, how's that possible? Well, let's talk about it. Because so much of it is making it interesting for them. Another is technology, of course. They're using it, they understand it. Apple stock has been one of the greatest teaching tools of all time. Do you like your iPhone? Yes, I like my iPhone. Okay, do you think that they make money off of you? Yeah, probably so. Okay, how? And you walk them through it. Alternative investments tend to be very much basic understanding of how business works and the economy works. And it's usually kind of interesting if somebody explains it in an interesting way, and that helps them get a concept and then from there monitor it. One thing I'll tell you, because I know you work with so many big families, multi-generations, I am such a big believer in actually having quarterly meetings as a family. They don't have to be crazy, formal, and boring, but they need to be touch points of, okay, here are some of the things we did this quarter, and here's why. What do you think is going on in the industry where you're in, and engaging the next generation? You don't even have to talk about dollars, because I know some people don't want to talk about dollars yet. At the appropriate time, they will. But say, okay, tell me you're in, coding. Tell me what's new in coding, right? You're in AI. Tell me what's new in AI. Whatever it is, it gets them to actually talk about it. And the last piece of the puzzle that I'll say that I try to say to everybody is get the second generation, the third generation in contributing and philanthropy early. One of the things that we always did is we would give Christopher, our son, he's an only child, say, okay, you have a certain amount of money. We want you to decide which charity is going to receive this. By doing that, they had to think about it from the perspective of, okay, I don't want to just waste this money. Who's actually needs it? And then how do I know for sure that they're going to put it to good use? And just all of a sudden they feel more bought in and they realize the blessings that they've received and the ability to bless others is really valuable. And that just makes them usually more interested in the overall concept of investing because it helps them grow to be able to help others and make an impact.
It's so spot on you bring that up. We actually have a philosophy at Generation Capital called the dimmer switch, right? You don't turn the lights on right away. You don't just show the brokerage statement, to the kids at, right after homework time. But one of the things that we do here to our listeners may be familiar with is Fidelity. That Fidelity Charitable has a great strategy called a gift to give. So you can take an allocation of your donor advised fund and give it to Timmy or Sarah. And at what we teach our clients is around Thanksgiving time is do some research on Fidelity Charitable or Schwab 360 and look up what is the CEO making? How is that relative? What % of dollar is going to the end participant in that charity? And by doing that, you can actually unlock that creative thinking. So that way, when you're looking at GPO, when Generation Capital puts that in front of you for the first time as you're allocating, now you can actually have that creative thought process to ask the right questions. And so I think it's a really powerful point you bring up.
And that's one of the other beautiful things about you doing that is in something that, they have to be age appropriate to do this, but to actually take them physically to a location and allow them to see exactly, what the charity does and how they go about doing it. It accomplishes, obviously, it's good diligence to be able to make sure that they're using the money correctly, but also it helps them realize how blessed they are and how grateful they should be for what they have and how many people in the world don't have that. And when that happens, there's a spark usually that the child becomes very motivated to be able to say, I want to do well so I can do good for other people. And that's just something I really try to encourage. And I love the way that you do that as a firm.
Yeah, it's one of my favorite things about GP stakes, which we'll dive into now. But there's nothing more I love than putting GP stakes in a charitable account like a CLAD or a CRUD or a foundation and kicking off that income and watching that income go out and make an impact. And that's really the power of owning a private asset firm through what you've innovated, is that tangentially you're making an impact not only for people's retirements, but for charities and foundations and endowment across the country. So I think that's really special. And let's kind of dive into GP stakes and then dive into some of the other funds. How does one go from an idea of, I want to create a fund that owns private asset firms, and then how do you have that aha moment? You're like, oh my gosh, this is actually real. People are investing in this. And I'll start by saying I had my aha moment when somebody called me, several years ago, and said they got their name from a client and they wanted to deposit $10 million with me and have me invest it. And I was like, you have the right number. It was like, you want me? That moment, I was like, oh my gosh, this is coming from an idea to something real. So what was your moment where you're like, Christopher, I want to deposit, $100 million or $500 million. And I just think it's so cool that you had such that, that moonshot, as I say, of creating this fund. And now everyday Americans are using those distributions to retire and live their life off. I think that's really powerful and special for you and your firm and your teammates.
Thank you. It's something we're honored to have been involved in. And what a lot of people don't know is how young actually the asset class really is. So it began, depending on which way you count it, 12 to 13 years ago at the longest. And what we saw early on, and it goes back to a little bit of what I said a few minutes ago, which is some of the very best investments, themes or specific investments, you just look at them and go, well, why wouldn't I do that? And it was that way when we learned about the ownership of private asset managers, because before, in the world of GP stakes, it had existed in public managers and in hedge funds. Well, for those that know the hedge fund world, if you have 2 years of great performance, you're going to make $1 gazillion. And if you have 2 years of bad performance, you're probably out of business. We weren't comfortable with the worst case scenario, so we didn't participate in that. But once the spectrum changed, or the aperture opened to include private asset managers, one of whom we knew very, very well here in Houston, another one that you mentioned earlier that we knew really, really well, that they did transactions and that we could actually own a piece of their business where they have contractually obligated management fees for a minimum usually of 5 years and sometimes as long as 10 years. And you're going to get that no matter what, and you get to participate in the growth of the business. That was definitely the aha moment of, this makes sense. This is where we want to lean in. That's why it's the largest investment, that basically we have as a firm. And for many of our vehicles, the largest investment that I have personally, because of the fact that it's just got so much predictability, is actually, it was funny. There was an article back, and I want to say it was 14 or 15, an institutional investor that became kind of famous is talking about GP stakes. And for whatever reason, this line that I gave became kind of a rallying cry for the industry. And it was, I said, I don't plan on getting hit by a bus anytime soon. But what I've told my wife and my son is that if I get hit by a bus, they can sell everything that we've got except for our GP stakes, because I can't replicate the downside protection. I can't replicate the positive asymmetry. I cannot replicate the cash flow, and I can't replicate the growth of the cash flow really anywhere else with that kind of risk reward. And of course, the joke is my son at the time was a teenager, and he was a little bit of a smart aleck at times. And of course, he said, well, Dad, you told me everything's for sale at the right price. I said, you're exactly right, son, except for in this case. Now, if somebody offers you silly money, you consider it. But it's too hard to compound wealth over a long period of time and to be able to do what the Buffetts of the world have done, et cetera, just by being consistent and having a business model that is truly advantaged. And a lot of people really still, even today, the industry's grown from about $10 billion of total market value when we got involved to well over $110 billion of market value today. But it's still small if you think of that relative to companies that have trillion-dollar market caps. But $110 billion market value is still pretty big. Well, one of the things that people still today don't understand is that the revenue is going to come no matter what happens. The management fees have to get paid no matter what. And people are like, well, I don't understand. Why would somebody keep paying management fees if the fund is not doing well? And it's not a choice. It's a contract. It's no different than if you place a contract to place an order to buy, I'm in Texas, you buy a bunch of cowboy boots, you're going to get delivery of those cowboy boots. You're going to pay for those cowboy boots because that's a contract. Well, same is true in the world of private assets. If Texas Teachers Retirement System puts money in a fund, $100 million into a fund, they're going to pay the 2% management fee or whatever the fee is for the next 5 years or 10 years, period. And every one of the listeners who has a business can appreciate this. If you know exactly what your revenue is going to be for the next 5 years, budgeting becomes pretty easy. It's the volatility that people obviously struggle with. Well, in this situation, you know exactly what the minimum amount of revenue you're going to make is for at least 5 years and maybe as long as 10. Then from there, you can hopefully deliver really good results and share on the percentage of the profits. That obviously gives you the upside that is very positively asymmetric because you've got the downside protection and the upside opportunity.
Predictability, free cash flow, moats. I mean, that's exactly what you want. I think that this type of investment fits into a portfolio so well. And for a lot of our listeners out there, and for you, Christopher, I'd like to see if there's alignment here. We were reviewing GP stakes with a client last week, and this particular family said, well, this thing's been on a tear. Is it going to slow down? And I was like, all right, explain the story. And one of the things that I feel like is we're in the second inning. Like, I don't know what inning you think we're in, but I think that there are significant tailwinds for private asset managers. There's more democratization. I think there's going to be more competition. What are things that concern you about the space, though, right? There's so many tailwinds. I typically wear a tinfoil hat to bed, so I'm always worried about the downside, just like you are. What are things that concern you about the space, and what are things that keep you up at night? Not for GP stakes, because we know CAZ is a great team and they're doing their diligence, but for the market as a whole, right? Some of these funds have risk and some of them are mismanaged. That's what keeps me up. What keeps you up?
So I would say that the industry has all the tailwinds you mentioned. I'll add a couple more. So you've got the democratization where now every single investor, regardless of their accreditation status, has the ability to access certain funds. You also now have the conversation about 401k plans. 401k plans are a complete game changer for the industry because for those who do not know this, investments in private assets had not been allowed inside of 401k plans until very, very recently. And even still, they weren't adapted because of some things that were done in the prior administration that made it very dangerous for anybody to add alternatives to their 401k plan or 403b plan. For a non-for-profit or for teachers or things of that nature. Well, what is now happening is the Department of Labor approved this, 5 years ago. But now what's happening, more than that, actually now 6 years ago, is that now the current administration is going to lay out the ground rules to make it very clear what is the appropriate way in which to invest in alternatives. And we don't know exactly what those look like, but every single person in the industry is lining up to say, how do I get access to those trillions of dollars that are now available that have never been available before? Further, what most people will say, and most of the studies will show, is the younger generation tends to very much believe in the core and explore strategy of, okay, well, I know I need to own some, just normal Americana, if you will, as passive investments, whether it be in an index, et cetera. But I also really like the fact that I can invest in other things that are not plain vanilla. And that, of course, is a big tailwind for the industry as that generation gets more wealth transfer. they're likely to allocate more and more to the alternative market. And then, of course, just the advent of technology and the ability to do things that weren't possible before at a scale that wasn't possible before. That obviously is another reason for tailwind. But what are the risks? The risks are that somebody does something silly and blows up. And then all of a sudden you have this big time headline that is like, oh my gosh, these things aren't safe, right? These people just should never have had that happen. And look at these poor people that got hurt. That's what the industry has to avoid. That's what I'm really trying to sing from the mountaintops is everybody do everything we can to grow, but do it the right way. Ultimately put the investor first in everything that we do and take care of the investments. Because if we take care of the investments and take care of the investors, then obviously everybody's going to do really, really well. So the beyond the industry of GP stakes or private asset management firms, the things that kind of keep me awake at night more than anything else is the concentration of effectively productivity and growth. Saw a statistic this morning. I haven't verified this statistic yet because I literally just saw it before I got into meetings all day long. But that basically of the 493 stocks in the S&P 500 that are not the Magnificent Seven, they're expected to grow earnings by 2 to 3% over the next 3 years. 2 to 3% growth. Translation, not even keeping up with inflation or barely keeping up with inflation. So the lack of breadth in the overall distribution of growth in the public markets does concern me a great deal. I also believe the Fed is in a box. The Fed is likely to stay in a box, regardless of what the administration says about cutting rates and this, that, and the other. Anybody who looks at the data will say that it's going to be very difficult for them to do it. Doesn't mean they don't do it some. It's going to be very difficult to do it aggressively because all the Fed governors know what happened in the late 70s, early 80s, that they cut rates too fast, inflation took off, and then all of a sudden they had to surprise the market and raise interest rates again. So I think we're back to a more normalized interest rate. I mean, most of the people watching this remember when an 8% mortgage was not actually unusual. That was actually pretty normal. Now people got used to a 2 or 3 or a 4% mortgage, and now they're freaking out because it's 6. Okay. 6, 7 is not abnormal. It's normal. So that's something I'm definitely concerned about. The other thing that really does, and this is very crystal ball, we're such beneficiaries of what's happening in the world of AI. We're early investors in OpenAI, which is ChatGPT for those that don't know, and many, many other things that have done really well for us. But the reality is that we're going to be not needing as many jobs in the future as we have today. And so as a result of that, we got to figure out what to do with all these people. Now, I think people are great, they're adaptable, and they're going to continue to evolve. But my statement that I've said many times is, AI will not replace people, but people who use AI successfully will replace people. And so we're going to have to adapt and adjust. And I don't know what that looks like. So we're trying to make sure that we invest in things that do not require this huge amount of job growth in order to be successful, because that, I think, is something that is not as predictable as it used to be.
I think that's in alignment where we started the conversation. It's innovate or die, right? If you're not using AI to screen, to amplify what you're trying to do, we use AI every day. We use approved vendors to scan trusts. In 30 seconds, I can figure out any holes in a trust. I can scan a tax return in 2 seconds and figure out. I scanned a tax return 2 months ago. I saved a client $600,000 in taxes. You got to be able to use this technology and innovate. I think one of the things that you pointed out is our viewpoint as a firm on rates. We at the time of this recording, we're mid-August. I'm not sure when we're going to get this out to the public, but the Fed could run out of arrows in their quiver, and we could kind of wind up in a situation like 2022 again. So that's why it's important for us to articulate that core and explore philosophy, where we're not giving up on bonds as an asset class and totally, because you always want to hedge your bets, make sure you're not totally wrong, but we're more shorter on the yield curve. But that's why we're picking up our allocation to alternatives, and specifically alternatives that produce cash flow, right? So we can round out that portfolio more. As we wrap up the conversation, Christopher, I think one of the things that we're super excited about is we call it the think tank, right? We at Generation Capital, I'm not afraid to break things, go try things, change the industry, democratize and deliver the world-class wealth management experience that we want to offer. We tell that to clients all the time. Our goal is to deliver a world-class experience. And the industry is evolving. There's no more days where you go to your parents' broker at Merrill Lynch and he puts you in a C-share mutual fund and he or she just never talks to you. I was interviewed by Barron's a couple weeks ago, and there's an article out there for whoever wants to read it. You can go to my LinkedIn on the great wealth transfer. And I think Wall Street has a really freaking weird obsession with next gen. It's bizarre to me. I don't think that these big banks know that my contemporaries, your son, I don't think he's waiting around for you to die. I would assume that he's paving his own way. If you ask Morgan Stanley, who is a great firm, they're probably, they've got a white paper on next gen, and it's you got to get the next gen. Well, we call it Generation Now, right? You have to be involved in Generation Now. And the article finishes by saying, a quote from me is that you got to be able to roll up your sleeves and put the elbow grease in and put the work in. So one of the things that we're doing in the think tank here at Generation Capital is innovating with CAZ, and it's been a great idea that you gave me and Clark and Dan Fink and a great partners at CAZ is working on democratizing access to unique investments, not only standalone funds, but can you talk to us about how you empower us to get unique investments that have been gone through that diligence test from CAZ, got through the 2,000 stack of paper, 500 obviously we threw on the top or in the locker room. But can you talk about that? Because I think that is going to be a really special way for our listeners to understand how to get access to things that are special, obviously in moderation in conjunction with their overall financial plan. But we're particularly excited about that.
There's so many opportunities to be able to do things, in a very broad, diversified way or in very much of a targeted way. And what we try to do is to make sure that we provide the advisor and the client with the ability to choose what's best for them. So we have some investors and investment advisors that literally, they just want to be in the fund and they just want to go take care of their business and that's all they want to do. And then there's others that want to do things that are more targeted. They're what we refer to as co-investments, or we call them conduits. You might have heard them referred to as SPVs or special purpose vehicles. They're all basically the same thing. And that is where, it's a very specific targeted opportunity that has, a very specific objective in a particular company or a particular sector or something of that nature that you can really lean into, and you can invest more in that particular opportunity because of either a unique desire to do so, the way it fits a particular financial plan or, roadmap, if you will. But we go through and we take everything that we do and make it available to people in whatever form it is that's best for them to own that asset. And that includes, for people that have insurance, insurance dedicated fund to be able to do something, or something that is a general fund, or something that is literally a single asset. We're looking at something literally right now that we're going to roll out here in the next couple of weeks that is a single technology name. We've been early investors in the company, and this is something that we believe is truly game-changing from the way the communication occurs, particularly at the edge, as it's referred to, or out in areas that are not necessarily easily achievable from a communications perspective. And to be able to do that at scale, just like we're doing in energy, where there's specific opportunities to participate in some of the most interesting new developments in the world of energy. And the same, of course, would be true in other areas of healthcare and technology, certainly in GP stakes, professional sports, et cetera. But to be able to give people the flexibility to choose what is best for them, and for advisors to have a totally curated list of things that they know we're putting our personal money in. And then in many cases, if somebody doesn't make money, we don't even get paid. So literally the ultimate alignment, where we're the largest investor and we don't get paid unless somebody makes money, those kinds of situations allow advisors the flexibility to do the best job that they can for the investor, and the investor to decide how they want to own those types of assets.
From an advisor perspective, CAZ is just an absolute dream because you've got the customization, the curation, the wherewithal, the resources to help empower our end clients to get access to things that they'd have to write a $10 or $20 million check for. As we wrap up, I have one question before I give you the floor at the end. Christopher, what's got you excited, not only in business, but in life? What's this next chapter of 2025, 2026? What are you most excited about in general?
Definitely, I'm very passionate about this business. I get asked the question all the time, why do I continue to do this? I do it because I love it. And the reality is that if I wasn't doing this as a CAZ Investments firm, then I would be doing the exact same thing for my personal portfolio. I would just be writing a lot smaller checks than obviously I do as this business. But so I really love what we do. And I am very excited about what's coming out of the laboratory. We got a couple things that literally I've had working for a long time that are going to be coming out. When those come out, I think they're going to be really great ways to add value for investors and to continue to democratize the world of alternative investments. Outside of that, having a 3-year-old grandson and an 8-month-old granddaughter, I definitely know I joined the cool kids club. Grandparenting is every bit as good as everybody says that it is. And so we have a lot of fun with that. And then continuing to just grow as a person, grow in my health. I'm very, very focused on, reading every day, learning every day, and obviously doing everything I can to continue to drive to success. And being able to share that with a lot of other people is a real joy for me because of the fact that I've learned so much over the 35 years I've been in this industry. And I love to share that information with others, both all the things I've learned to do well and all the scars and all the mistakes that I've made over time, because all of us have benefited in many ways more from our mistakes than our victories. And so ultimately, we just like going out and delivering that message to people and helping them benefit from that.
I love learning from other people's mistakes. Oftentimes, the things that I've learned, I always joke with clients, don't worry, I've made that mistake on somebody else. They'll never do that again. I'm a big believer in spinning the wheel, not reinventing it. Well, at this point, I feel like I could run through a brick wall. I don't know if alternatives do that to everybody, but I'm pretty jazzed up. As we end every podcast, the floor is yours, Christopher. To our listeners out there, CAZ Investments, how do they get a hold of the team? What do you want the listeners to know? Anything you want to say to wrap up? The floor is yours.
Well, one of the things that I appreciate that very, very much, and thank you for having me. This has been a lot of fun. Obviously with advisors like you, the first place of contact is for them to contact you. But at the same time, we do have a lot of educational material that is available at CAZinvestments.com. And my LinkedIn profile, our firm LinkedIn profile, we put out a lot of content. So feel free to follow that. It's something to where, one of the reasons why we wrote the book, The Holy Grail of Investing, is to be able to provide people with a tool to be able to use for themselves, but also for other people. One of the things I was actually most proud of after we hit New York Times #1 was that I got a call from a friend of ours that literally bought books for every single member of their son's fraternity pledge class. Because everybody needs to get this baseline knowledge of what investing is all about in alternatives, and they can all benefit from the life stories and the success stories of the people that we interviewed for the book, talking about how they've had this incredible journey and how they've been able to be, at the top of the industry in which they play. So like anything else, this is about a lifelong journey of learning for everyone. And that would be my encouragement. So, one of the things that I've tried to say to everyone is that we were all born to be impactful on our family, to be impactful on those that we work with, to be impactful on those that we come in contact with. And so one of the advantages of being blessed monetarily is we can all be impactful, not only by making memories for people, but also by hopefully helping people that need it. So that's what I really just encourage everybody. And any way we can be helpful, just reach out. We're happy to do that.
Well, you've certainly made an impact, not only across the average American's retirement portfolio or charitable trust. You made an impact on me health-wise. I share that message with many people. To our listeners, I strongly encourage you follow the Holy Grail podcast on YouTube, co-hosted by Tony Robbins. And if you have not read the Holy Grail book, feel free to reach out to us. We will send you a copy from Generation Capital Advisors. Christopher Zook, thank you for being part of the G360 Wealth Podcast. Thank you for the great returns. Hopefully we keep those up. We have noted that if we have a down quarter, we'll re-up. And if you like this episode, please feel free to share it, like, and subscribe. And I hope everybody has a blessed day.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.